Hello everyone, this is Professor Srinivasan here, and this time I'm here with a short video on the recent debacle in cryptos. Well, I do not want to start this video by saying I said so, but then the sad part is, and the truth is, I did say so. I've always been warning all of you to stay away from cryptos because frankly, I was not convinced of this particular class of so-called financial asset. There are many reasons for my discomfort and we will discuss them one by one, and once we have gone through them, you may possibly be able to identify what went wrong. Cryptos have always been considered as one of the most volatile of all financial assets, with roller coaster movements. And the recent crash in May 2022 only reinforces its volatility. A whole lot of traders have been left high and dry, and if you are one of those who parked your entire savings into this volatile asset, then God bless you. So without any further delay, let's begin and try to understand what are the things that can go wrong when you invest in an asset like cryptos. Let's begin. So first of all, let us first understand what is crypto. Well, it seems a little bit late in the day to understand what this gunk is all about, isn't it? But then, to maintain the sequence of this presentation, let's go through this grind. A cryptocurrency, as you all know, is a digital currency that is powered by blockchain technology, making it nearly impossible to counterfeit or double spend. Cryptocurrencies are decentralized, meaning they aren't subject to the control of government or financial institutions around the world and are therefore supposed to be insulated from broader economic trends. That's a joke, right? Cryptos have become very popular in the recent past due to their potential for huge capital appreciation and also as a tool for hedging against traditional currencies. That's a bigger joke. There are some optimists who believe that cryptos will ultimately replace the traditional currencies. Maybe yes. Maybe not. But then, maybe human beings will one day colonize Mars also. I, for one, have always preferred to place my bets on traditional financial assets like equities, bonds, gold, etc. Well, they may have not fared very well in the recent past. But then, a known devil is a lot better than an unknown angel or something along similar lines. But then, I was mocked by a whole lot of Gen Z for being old and outdated. I may be outdated, old and toothless, but then I'm the one who's smiling today, isn't it? Anyways, let's get on trying to figure out as to why cryptos crashed. Now there are a whole lot of reasons attributed to this crash. In this video, we may possibly try to cover a few of them. The first one is the utility value. Yes, show me the utility. What is the utility of crypto? Can it be used as a legal tender? One may argue that some tiny country which is barely a speck on the global map has adopted it. That wouldn't make it globally acceptable legal tender, would it? For the most part, cryptos are not used as a medium of payment. They are just used as an asset class to be held as investments and for trading. It is just a digital asset with little or no real world usage. That being said, an asset with no real-world usage will finally crash. I mean, how long can speculation prop up such assets? The next possible reason could be government regulations. Cryptos are subject to too much governmental regulations and restrictions, and maybe rightly so, because any asset which is fictitious and with little or no real-world usage, but at the same time is highly volatile, needs to be regulated, or else they could plunge the entire global financial ecosystem into darkness. In September 2017, the Chinese government imposed a ban on initial coin offerings (ICO) and ordered all crypto exchanges to cease their trading activities. The result? Bitcoin plunged by more than 20%. China did not leave it at that. It kept its foot pressed on the gas. In 2021, China put a ban on all crypto-related activities. The result? Multiple crypto miners shut down shop. Add to this the fact that there is no telling what kind of restrictions will come up in the future. After all, who can predict what the government would do in the future? This kind of uncertainty results in a sell-off by investors the moment there is a slight hint of any regulation possibility. But here's a fun fact. China miners contribute 65% of the mining activities worldwide. The next reason is what we call as FUD, fear, uncertainty, and doubt. Although the very idea behind cryptos was to have a universally acceptable legal tender, which would be totally delinked from broader economic trends, that, my friends, will never happen in reality till the time the crypto's values are linked to other currencies. Any negative news about any crypto often triggers a sell-off in other cryptos. So more often than not, there is a domino effect. Further, any southward movement in major stock exchanges or economic downturns causes the investors to panic and they head towards a sell-off. And on top of that, events like the iconic fall of algorithmic stablecoin Terra USD and its sister currency Luna embeds fear in the mind of investors. These kind of events really scare off the investors. The next possible reason is that in a market which is so heavily dependent on technology, the hackers rule. Crypto exchange hacks can also lead to panic sell-off. If any of the crypto exchanges hacked and the investors lose their funds, obviously the investors will start doubting the entire system, and the fear of losing their funds which are parked in other cryptos sets in. This again results in hordes of investors offloading their investments in various cryptos. We all remember the infamous Mr. Gox hack in 2014, for instance, led to the loss of 850,000 bitcoins, worth over $470 billion at that time. And this in turn resulted in a 20% fall in Bitcoin prices. The next possible reason is what we call as the curse of leverage. Well, we all know what leverage trading is. And as in the case of any financial assets, when the prices are moving northward, it brings into markets a whole lot of players, and not all of them have deep pockets. It attracts players with shallow pockets who come into the market with the dream of making quick money. But the problem with these shallow pocket investors is that they often trade on margins. That is, they take leveraged positions. And when you trade on leveraged money, you stand to make huge profits. But then you also stand to make huge losses if the markets move against you. In many cases, the leveraged traders do not have the financial strength to make good the margin calls when the prices move against them, and therefore end up liquidating their positions at a huge loss. A concerted wave of sell-off by such leveraged players only cascades the already falling markets. The next reason why a crypto market could crash is because of tech glitches. Sometimes a crypto crash can be triggered due to technical issues. For example, a technical issue with a particular currency can lead to a sell-off not only in that particular currency but also in other cryptos. Now, this was the case with Ethereum in 2016 when a hack led to the loss of 3.6 million Ether worth $50 million back then. The next reason that could result in a negative sentiment in cryptocurrency is scams and scamsters. Now, whenever any market moves northwards, we all know that amateur investors are lured into the market. And whenever amateur investors are attracted by windfall gains, scamsters are never far behind, are they? These scamsters are always on the lookout for soft targets who are not very aware of the market and are looking for making some quick buck. The rug pull scam in the Squid Game coin and the pump and dump scam in Phase coin left the gullible investors poorer by some $14 billion. Yes, you heard the figure right, $14 billion. These kind of scams leave the investors with a bitter taste in their mouth and a lot of distrust in the market. They not only turn skeptical about such financial assets, but they also offload their holdings in other cryptos, leading to a mass sell-off. And finally, you have, like in any other market, the manipulators. Market manipulation is a big factor in investors losing money. Now, it's a well-known fact that a few ultra-wealthy individuals, known as whales, often control the way the market moves. Crypto whales, like in any other markets, are individuals or group of entities who buy or sell in big quantities, thereby moving the market to their own benefit with their money power. Now, having discussed all this, finally we come to the question, should you invest in cryptos? Well, there is no right or wrong answer for this. It depends on your risk appetite and the size of your portfolio. If your portfolio is sufficiently large, then you may deploy a very small amount of money which you can afford to gamble away without losing much sleep in cryptos. This can of course provide you with a kicker into your returns. But if you're not someone with a large portfolio, then my advice would be stick with the traditional assets and watch the crypto game from the sidelines. It is sometimes better to be a spectator than actually playing the game, more so when the game involves bloodshed. That's all for this video. Take care, stay healthy. Ciao.